Bueno, pues el día de ayer ya fue presentado plenamente y hoy va a ser la segunda conferencia. Es sobre la financiarización en los países en desarrollo, en las economías emergentes, flujos de capital y expansión del crédito. Entonces le vamos a dar la palabra y después de la presentación pues ya organizamos la sesión de comentarios. Sí, si está prendido, no se oye nada. No. ¿Quién sabe de esto? Yo creo que es importante para la grabación, ¿no? Parece que ya está esto, entonces repito, es la segunda sesión con el doctor Özgür Orhangazi y va a hablar de financialización en economías en desarrollo y emergentes, flujos de capital y expansión de crédito. Entonces le damos la palabra al doctor Orhangazi.
Okay, muchas gracias. Like the seminar yesterday, I will begin with a theoretical approach and then look at what's going on in developing and emerging economies. And again, if there are any questions, if there's anything that's not clear, you can always interrupt and ask. And if you have more sort of serious questions, we can discuss them after the presentation. So, can you hear me if I speak like this? Okay, perfect. So, what I am looking at in this study is basically a group of developing and emerging economies and the relationship between capital inflows into these economies and credit expansion in these economies. Okay? And then I will talk a bit more at the end about the Turkish economy, the particular case that I'm very familiar with, and sort of talk about how this relates to what is going on in developing economies. Now, one of the important things, and we already know what's going on in this, we talked about it, if you were here yesterday, a little bit, mostly about the US context, but what has been happening in the last 20-30 years is a significant growth in global financial assets, okay? And these global financial assets include stocks, bonds, different types of bonds, as well as securitized loans and all sorts of different financial assets. In the world economy, in 1990, this shows you the stock of debt and equity in the world. So this is sort of total financial assets. Not all of them, you know, you don't have derivatives and stuff here, but what you had in 1990 was only $56 trillion. And it keeps increasing and increasing, and you come here, you reach to 219. And now with the crisis, it sort of slows down. The increase has been sort of slowing down, okay? Now, what you have is a significant portion of this capital has been going to developing economies, okay? And what we know about these flows is, first of all, since late 1970s, there has been 4 waves or cycles of capital flows to these economies. The first one was small, but it began in late 1970s and ended with the early 1980s Latin American debt crisis. And then you have another cycle starting in early 1990s, a boom in capital flows, ending more or less with the 1997 East Asian crisis. Okay? And then a few years later, in early 2000s, you see another wave of capital flows going to these economies, and they sort of stop in 2008, and I will show some numbers. In 2008, when you have the US financial crisis. But interestingly, after 2009, or starting in early 2009, following the American Central Bank's Federal Reserve's interventions, you see a new boom in the capital flows to developing economies. Okay? And that seems to be slowing down as we speak right now, since the end of last year. That seems to be slowing down. Did you want to go in?
I see, yes.
Cycles, and then the fourth one seems to be coming to an end. And what we know, what happened in these previous cycles, is we see three things happening in the developing economies when you have an increase in capital flows. The first one is you will see most of the time that an increase in capital flows leads to current account deficits, or increase in the current account deficits, and appreciation of the currencies, leading to overvalued exchange rates. Two, most of the time you have what we call currency maturity mismatches, in the sense that some of the institutions, either financial institutions or firms, borrow in foreign currency but have their earnings in domestic currency, which creates some sort of a mismatch on their balance sheets. So that's the second thing that you see. And then going along with these, you see bubbles either in credit markets or asset markets. You see bubbles in stock markets or real estate markets. Those are the asset markets that we're talking about. And most of the time, what you have is as soon as capital inflows stop coming in or are reversed, that is, capital begins leaving the economy, you're faced with a sharp decline in the value of the domestic currency, which had been appreciating before. You see a lot of defaults and or difficulties that the firms have in terms of servicing their debt, and those bubbles, either in the stock market, real estate market, or wherever they were, they start sort of coming down as well. Okay, so these are, we kind of all know this stuff, that we've seen it in many different countries many times over and over. However, when you look at economics theory, when you think about capital flows, right now pretty much all the economies in the world are open to capital inflows, and they let capital inflows sort of support their economy in a sense. And behind this, the theoretical approach in the economic theory is as follows. According to the standard economic theory that we talked a little bit about yesterday, what you have is, hold on. Let me just stay here and I'll come to that. The standard economic theory is this, that developing countries do not have enough resources for investment mostly, okay? And if you open the economy to capital flows, foreign capital is going to complete support the domestic funds and will lead to an increase in domestic investment, will lead to an increase in economic growth, and overall it will create a situation where those inflows will generate a level of economic growth that is going to enable these economies to pay back that debt. Okay? Now this is one thing. We all know this thing. On the other side of this, what I'm thinking about is how these capital inflows, when they come to developing economies, operate. What are the channels through which they contribute or create fragility in the economy? That's the question. One significant channel in a lot of economies, in a lot of developing economies, is the channel of credit, the bank credit channel. Okay? What you see, and this is a very sort of like recent phenomenon, but in the last 10, 20 years, you see a significant amount of credit expansion in developing countries, which is not as much as the US economy that we talked about yesterday. In the US economy, the household borrowing, for example, was skyrocketing. Not as much as that one, but there's a significant expansion in credit in the developing economies as well. Okay? Now, if you think about credit expansion, the credit expansion could be something good. Okay? If you read a standard economic theory textbook, you will see that the credit expansion is going to be taken as an indicator of what we call financial deepening. Financial deepening is the enlargement and development of financial markets. And this is usually considered something positive for the economy because it does two things. The expansion of credit could basically help the economy grow by mobilizing savings. If you think about a very basic economy, on the one side you have those who have savings, and on the other side you have those who are going to make investments. The development of financial markets and the development of credit enables mobilizing these savings and transferring them into investment. Okay? And what you see is essentially what's called a portfolio optimization for households and firms. As a household, you optimize your portfolio in the sense that you optimize your savings. You decide what you're going to do with those savings, and then you basically transfer them to those who are going to make the investments. Now, an expansion of credit could signify, according to this theory, that you get rid of problems where those who have investment ideas don't have funds for finance, or you could see that banks allocating this credit in an efficient way to various users that the firms might have. Okay? Now this is very standard view. So credit expansion is good, it contributes to growth, it contributes to investment, and so on and so forth. However, when you have periods of rapid credit expansion, when credit expands, credit grows at a very fast rate, it could lead to some problems. Okay? Some of those problems are discussed in what we call the heterodox literature. Okay? And the main problem is if in an economy, there is a rapid expansion of credit, there's a large amount of debt accumulated, this makes the economy vulnerable to any sort of shock. Okay? If anything goes wrong in the economy, if you have any sort of problem, it could have an impact larger than it would otherwise have. So for example, if you have any change in credit availability, or if you have a change in interest rate, their effects could be quite large. Now what happens is, for example, if the amount of credit in the economy has grown rapidly, okay, a sudden change in the interest rates could make it very difficult for people to pay their debt back. This includes both households and firms at the same time. Okay? So, the expansion of credit or borrowing is not necessarily something good or something bad. You have to look at what is going on. But
you have to keep in mind, you have to think about it, that expansion of credit could, as it helps grow, could also create fragility. Okay? So that's sort of the approach. Now, the question I have is whether there's a relationship between inflows of capital into developing countries and expansion of credit in these economies. Okay? Because if those two are related to each other, if capital inflows are causing credit expansions, leading to credit expansions, then this means that when capital inflows stop, or when there's capital outflows, then you will have problems with the amount of credit in the economy as well, and you are likely to have problems in terms of credit crunches, debt crises, and or bankruptcies as well. Or in other words, it might mean that your domestic economy, the credit in your domestic economy, may be dependent on the movement of foreign capital, okay? Which is very important both because of its instability implications, but it's also important in terms of economic policy, okay? If one of the significant indicators, one of the significant determinants of your domestic economy is determined from outside the economy, then that means that you have trouble in terms of controlling its effects in the domestic economy. This has been a very significant problem in a number of countries in the last 4 or 5 years, okay? If you look at it, in the expansion period of the credit, when you have a significant increase in credit, you usually see an expansion of economic activity, and in developing economies, it's most of the time not investment, but consumption. The consumption activity is the first one that grows. And you will see that most of the time, a significant portion of this consumption is all consumption of imported products as well, which then leads to changes in the current account deficit. Then in many cases, in the last 4 or 5 years, you see property bubbles, current account deteriorations, and changes in the vulnerability of the banking systems. Okay? Now, what has been happening? Again, does this make sense so far? The story that I'm trying to sort of tell? Okay. So what has been happening? Again, let's look at some numbers and let's think about these numbers. These numbers, this graph is the private capital inflows into emerging economies. Starts from 1995, goes all the way to the beginning of this year. Okay? Now, what you have, the red line is showing the levels, and the blue line is showing it as a percentage of the GDP of these economies. So what you have, the last cycle I'm talking about, begins in early 2000s. It goes up, you see the significant increase in capital inflows to developing economies, and it stops in 2008. This is the year where you have the US financial crisis. It sort of comes down, stays there for a little bit, and then in 2009, it starts going up again, okay? But it's easy to understand what was going on here. That's the period of crisis, and most of the financial investors did not know what to do. All sorts of different investments were very uncertain. It was not clear where it was safe to invest, so that stopped. But starting with 2009, you have the Federal Reserve already has brought down the interest rate to 0, has started quantitative easing, has started giving large amounts of credit to the financial markets. So, the Fed's quantitative easing, the credit that the Fed provided to the US market, and then after that the European Central Bank started doing the same thing because of the European crisis, the credit that the Fed started giving went to 2 places. One, to the stock market in the US. So you see a significant increase in the stock prices in the US. and 2 to the developing countries. Okay? And the idea here is in the US are close to 0%. What you do is you borrow in the US at 0.25% and go and invest in developing economies where the interest rate is 5, 10, 15%. And as long as there is not a change in the exchange rate, you make a very large amount of profit. Okay? But as we talked about, most of the time, when there is capital inflows, there is also currency appreciation. Okay? Which means you go in, you make a profit from the interest, and as you are going out, because of the currency appreciation, you make an extra profit. Okay? Which makes this business really profitable, which then keeps sort of like bringing more and more and more into it. What happens is, at some point here, and this is sort of like the share of GDP, as the share of GDP has started declining, the Federal Reserve announced in May 2013 that they would slow down, not stop, but slow down their quantitative easing. Okay? At which point, the capital that has been flowing to the developing economies also slowed down. They started going back to the US. Okay? Now, if you look at these numbers at a sort of disaggregated level to see where most of the capital went, the red line here is the Asian countries. Okay? And then you have Latin America right under that. Then you have mostly Eastern Europe. And then this is Africa and Middle East. You see that the Africa and Middle East is very low and sort of stable as well. But for all the other regions, you see there's a significant increase, especially for Asia and then Latin America, a little bit for the Eastern European economies. Okay? And in most of these cases, you see, as we talked about, an appreciation of their domestic currencies as well. Okay? Now, if you look at it, I have tables. I won't look at them, each one of them, in detail, but I have some numbers for different economies in these different regions to see what has been going on. The NPKI in the title is net private capital inflows into these economies. It's net, okay, which means it takes out the outflows, and it's private, which means it doesn't take into account government aid or money coming from IMF or those kind of institutions. It's basically all private investment being done in. Now, Argentina is well, you know the story in Argentina, you have a crisis here, and now for a long period you don't have much of a capital inflow, but that sort of changes in Argentina with the 2000 cycle. You have an increase in capital inflows, you have the US financial crisis, and after that, another increase. And then there's a slowdown in the last couple of quarters. This is Brazil, a similar story. I mean, the magnitudes are different, but the story is similar. This is the cycle of 2000s. Slows down. This is 2008. And then again, after that, there's a significant increase. Chile, a similar picture. You see, especially if you compare with the earlier years, you see the sort of like dimensions of the credit, the capital flows. This is India, to take a case from the Asian side. And again, I compare it with the 1990s, early 2000s. You see that this is a very large amount of capital inflow in India as well, just like in many other places. I have Mexico. You might be familiar with this. Does this seem right? This seems about right? So you have in Mexico as well, this is 2008, 2009, you have a slowdown. And I don't know, there's one quarter here that there's capital outflow, but it's very little. There might be something going on here. It's possible that some foreign company took its money out or something. I don't exactly know, but maybe you can tell me. But then you see this sort of the same trend. Okay? South Africa. And in South Africa, you see sort of like this boom has been a little bit stronger than this one. But then, you know, you have a very similar story going on there too. Okay? So this sort of like, you know, this shows what has been going on in terms of capital flows. Capital has been flowing into these economies and at higher rates, at larger amounts, especially in the last 4 or 5 years. The second question I have, that's sort of what we're trying to look at, is what happened to the credit in these economies, the domestic credit in these economies. Okay? Now, it's difficult to measure domestic credit. What I do basically is I look at the total bank credit to the private sector. I don't look at if the banks are lending money to the government. I don't look at that. I only look at what the banks are giving to the firms and consumers in the real sector. Okay? I'm not looking at if the banks are lending to each other either. So what I have is bank credit to private sector. The bank credit to private sector, if you look at it, has different sort of like shapes in different economies, depending on what is going on there. In Argentina, the bank credit significantly declined after the crisis in 2001. And then you have a trend of going up, not too fast, but you have a trend. And it increases faster. Remember, this is the period when you have an increase in capital flows. So in that period, you see an increase over that. Brazil, if you remember Brazil's picture, it was pretty sort of low until here. And after here, you have an increase in capital flows. This is the credit expansion. Now, what this shows you, in the case of Brazil, for example, this is the total banking credit to the private sector as a percentage of GDP. As a percentage of GDP. So, at the end of 1990s, it was about 30%. And when you come to 2012, that's the latest data, it's more than 60% of the GDP. So Brazil is a special case in that sense. Chile somehow always had a very high bank credit. But in Chile as well, that has been quite stable for a long time. After that, you see an increase, if you don't count the decline in 2008, and then a decline, and then another increase again. Indonesia has a similar trend, and this is Mexico. In Mexico, it seems like the bank credit is not very high. The bank credit, as a percentage of GDP, starts at 5%. Compared with many other economies, this is very small, but there's a decline, and then with the capital inflows, you see an increase. The increase is kind of rapid, but the ratio is not too high. So at the end of the day, you have a little bit more than 5% of the GDP as bank credit to the private sector. Okay, so that's. But for example, you look at South Africa, you don't see much, but Indonesia, Brazil, and as I'll show you, Turkey have very significant increases in terms of bank credit to the private sector. Okay? So, what you can do, what I did, is to take one case that I know best and look at how this thing actually works before talking about the other cases. So, the case I took, and you didn't see any graphs of that here yet, but the case I took was the case of Turkey. Okay? Now, in Turkey, you see two things. One, a very significant increase in capital inflows, and two, a very rapid increase in credit. Okay? And this is the picture that's very much, very often used when you look at the relationship between GDP growth and capital inflows in the Turkish economy. Okay? So these bars show the amount of capital that comes into the economy, and the line is showing the growth rate of the GDP in the economy. So what you have for example, is 99 is a year where there was an earthquake, so that's why you have a negative growth rate. But 2000, there's capital inflows, there's growth. 2001, capital leaves the economy. This is the same year when you had the Argentinian crisis. Turkey had a similar crisis as well. Capital leaves the economy and the growth rate turns into negative. And then slowly you have high growth rate. And here, capital inflow slows down. You don't have a capital outflow. You only have a slowdown in capital inflow, and you have negative growth rate. And then you have capital inflows again, you have growth, except the last year, 2012, you had very large amount of capital flows, but you didn't have much of a growth. But the story most of the time is that when you have capital inflows, the economy grows. When capital inflows stop, the economy slows down or even shrinks. So that's it. What has been happening to credit? This is the credit in the Turkish economy. Again, you have the 2001 crisis, which decreases the amount of credit in the economy. So this is about 10% of the GDP. And then if you follow this, when you come here, 2012, at the end of 2012, it's above 50% of GDP. So, I don't know, for example, start from here. This is about where the capital flows are beginning to increase significantly. From 20% to 50%, more than twice the amount at the beginning of. So in less than 10 years, the amount of credit doubles, more than doubles actually. Okay? Now the question is, two questions. Where is this credit going to? Okay? Because that makes a big difference. And why is this increasing? Now, if you take a bunch of countries, Turkey, Brazil, Indonesia, India, and South Africa, you see similar pictures. In fact, recently these 5 countries have been called the fragile 5, because what you see is an increase in capital flows and increasing credit. Now, in this case, most of the credit goes to either consumption or construction. Okay? Now, where the credit goes makes a big difference, because if credit goes to investment, that means you increase your productive capacity, that means you will be able to produce more, which means you will be able to pay the debt. But if you're just consuming, okay, it means you're not creating anything new, which means you will have problems when you are going to pay the debt. That's the main problem with borrowing. The main problem with debt is you have to pay it back. Okay? If that wasn't the case, you wouldn't have any problems. So, now, the question I have is, how is this related? How is this related to capital flows? Does capital flows increase the credit expansion? And there are 2 cases that we can talk about. One, when you have capital inflows, there are different types of capital inflows. One of them is when domestic banks borrow from abroad, bring the money in, and then lend it. Okay? That's one way that capital flows would increase the credit. The second way is when you have capital inflows, it could create appreciation in the asset markets. For example, it could create an appreciation in the real estate market or in the stock market, which then people can use as collateral and borrow more. Okay? So, in a sense, at least on paper, your wealth increases, which means you can now borrow more. Because most of the times, banks will lend against the collateral. So there are 2 channels to which this could happen. What I do is I make a distinction between a normal slow increase in capital in credit and the credit booms where the credit expansion is really fast. Okay? So in normal times, credit could expand slowly. That may not necessarily create problems. But if you have very high rates of credit expansion, then that could create problems. Okay? And I use a simple technique to measure if you have unusual increases in the credit expansions. And the way I do that is I look at the growth rate of credit. Okay, so basically I take monthly data from banks. Using that monthly data, I look at each month how much credit was increasing. Okay? And then I look at the standard deviation of this. Simple. So for example, one month it was increasing by 3%, next month 5%, following month 2%, whatever. I have all those numbers. And then I'm looking for periods where credit is expanding too fast. So for example, you could have a month when credit expands by 10%, 20%, or something like that. And in order to have a measure of that, basically I say, let me see the standard deviation of this and multiply it by 1.75, which basically, if you remember your statistics course, if you have some sort of a distribution, if you multiply by 175, you'll have the periods where you have, they're kind of like far away from the average. They are under the tails of the distribution. So if you have some sort of a normal distribution, for example, okay? Those are the periods where you have very rapid credit expansions, higher than the average, okay? And I apply a very simple technique called a logit regression, okay? And I look at the relationship between capital flows and the months when you have rapid credit expansions, okay? Now this is the sort of picture of the growth rate of credit. So you see, for example, most of the time it grows like 1% to 2%, you know. But then there are periods where it grows really fast, 5%. And you see, at these times, it grows much faster. These are the periods when you have the capital inflows, okay? And then at periods, it declines very rapidly. You have negative credit. So this changes. What I do is I basically take the periods where you have rapid expansions, okay? And then look at whether there are significant capital inflows before those months, okay? That's sort of the idea. If you have, let's say, the previous month or the previous 3 months, if you have an increase in capital inflows, then are you having an increase, a rapid increase, a larger increase in the capital, in the credit expansion as well? Now this is going to look a bit complicated, but I'll explain what it is and what it does and what it says. And you have to believe me. But the main question, remember, I'm asking is, do capital inflows lead to expansions in credit? Okay? So what I have as the dependent variable here is credit expansion. And I'm looking at when you change capital inflows if credit is expanding. But credit could grow because of different reasons. One of the main determinants of credit growth would be domestic interest rate. If the interest rate is low, people will borrow more. If the interest rate is high, people will borrow less. So I have to look at that as well. Another thing that affects credit boom is how we feel. In the sense that if you feel like the economy is doing good, if you feel like your income is growing, then you might actually borrow more. This usually is referred as the consumer confidence index, how confident the consumers are. So I look at that one as well. And then the availability of credit could change depending on, in our age, what the Federal Reserve is doing. If the interest rates are low in the US, you have global liquidity, and if they increase the interest rate, the liquidity goes down. So basically what I look at then is, I look at capital inflows, the domestic interest rate, the US interest rate, and consumer confidence index, okay? Now, what this shows is when you look at the capital inflows always have a very significant and positive correlation with the credit booms. Okay? You can look at the capital inflows in the past month, in the past 6 months, or in the past year. It doesn't matter which measure. Expansion of capital inflows increases the chances that you're going to have a credit boom in the economy. Okay? And depending on which measure you're looking at, this one tells you that if you had an increase in capital inflows the month before, the chances of having a credit boom this month is 10% higher. Or if this one is doing it for the last 12 months, that is the last year. So if in the last year there was an increase in capital flows, the chances of having a credit boom is 32% more or less. After you control for the other variable, the sign doesn't change. So, but you basically get the idea. For example, for the interest rate, you see that the interest rate is negatively related. When the interest rate goes down, the credit expansion goes up. The interest rate goes up, the credit expansion goes down. So if you control for all these ones, now this is interesting because what it does is when you look at the graphs, you see that the capital flows are increasing and credit is increasing at the same time for some countries. But this tells you this relationship is very current in the sense that if you look at monthly changes, capital inflows have a very significant effect on the credit expansion. Okay? This is not the only way of doing this. There are different ways of doing this as well. You could do what you call a time series econometric analysis as well, with the same variables. And don't worry about all these little numbers, but what it says basically is, this is sort of like, the second line is the capital inflows again. The capital inflows, no matter how you do the measurement, no matter how you do the econometric exercise, the capital inflows always have a positive impact on credit growth. Okay? After you control for the variables that change it as well. Okay? You could do a time series analysis, you get the same result. You could do what we call a vector autoregression analysis, and again, you get basically the same thing. The coefficients are almost same as well, around 0.3, and always it says that the capital inflows are affecting your credit availability in a positive way. Any questions about? Yes.
En esta relación entre los ingresos de capital y la situación del crédito, también es importante tomar en cuenta la estructura de los ingresos de capital, short term, long term.
Oh, okay.
Porque en el caso de Turquía creo que es
Exactly. There is no distinction in short term and long term here. This is total capital inflows. And it would make a difference. But in the case of Turkey, I did not do that, mostly because of these credit flows, of this expansion. About this much is short term. Long term is very, very little. Long term is very, very little. And what is usually considered as long term in the statistics, FDI, could still be considered short term because it's mostly going to the stock market. If you buy more than 10% of a company's stocks, that's considered long-term investment. But it's still stock investment. But you're right, if this is mostly short-term, and it makes a difference. If you had a long-term, then that would be a different story. Thank you. So, any other questions about, if anything is not clear about this? Now, I'm not going to go into the details of this method and bore you, but basically these results have significant implications. We already know that capital flows can create instability, can create fragility in economies. Okay? We know that they cause current account deficits, they lead to appreciation of the currency, and then there's a collapse and everything. Now, what this tells you is if you have a credit market that's expanding at the same time, especially in the last 10, 20 years, for the developing economies, the credit channel has become a very important channel as well. Okay? In other words, when capital leaves the economy, because that's the story with capital flows. You have capital flows, you have capital outflows. When capital leaves the economy, most of the time you have depreciation and you have most crises, it's the government who can't pay its debt, gets help from the IMF or whatever. But now you also have the private sector who would have problems in this setup. So if credit stop, capital flow stop, then the credit expansion would stop, okay? And you would have troubles in the domestic credit markets as well, in the private domestic credit markets, okay? And this would be a significant channel through which the changes in the capital flows could create instability in these economies, okay? And this is supported basically for most of the economies so far. I looked at the trends, and it seems like the trend. And for the Turkish economy, I looked at it in more detail, and it seems like these results are supported by those two types of empirical approaches at the moment. Okay? I don't want to sort of keep talking about this. This is something that most of you are familiar, at least in terms of capital flows. But I would like to take your comments and questions, and I would like to have a discussion about this, if that's okay. Thank you very much.
A proceder a las preguntas, yo creo que la plática da para mucho, combinada con la de ayer, para mucho más. Se supone que yo tengo que hacer algunos comentarios sobre el material, pero creo que es tan rico el material, y yo tendría, como todos los demás compañeros que están aquí, preguntas que hacer. Entonces voy a tal vez, alguna de las cosas que me gustaría es conocer un poco más la experiencia turca, que hasta donde conozco es algo parecida a la de México. Hay muchas similitudes entre las dos economías, también muchas diferencias. Algunas de las preguntas pues estarían, como se dice, en los detalles, ¿no? Los casos hay algunos casos muy específicos, problemas específicos de las economías. Ya comentaba ahora la compañera Nora de algunas cosas en relación con los datos específicos de México que no le casaban. Pero vamos a dejar entonces que todo el mundo participe, y en todo caso hacemos una reflexión final con el profesor. ¿Sí?
The economic growth in the Turkish graph, I saw that when there are capital inflows and the credit grows, it could be also that there are also the outflows. It could maybe about consumption credit, because I think that you said that consumption credit doesn't produce anything. And do you think that could make the domestic interest rate rises?
Podemos juntar 2 o 3 preguntas y vienen las contestaciones. Ángel.
Sí, muy breve. Turquía tiene su propia moneda, la lira turca. ¿Cómo se ven las posibilidades en este momento de Turquía? En esta situación pues hay una crisis bastante fuerte financiera. ¿Qué márgenes tiene por tener una moneda propia, y cómo se ve la situación en relación al euro? Porque Turquía busca de alguna manera, tiene una situación aquí, y se puede extender mucho sobre esta pregunta. Gracias.
Tengo una observación. En el caso del crédito bancario en México, es alrededor del 14%, no sé por qué da la cifra tan baja con respecto al sobre 14, como 5, ¿no? Esa es una. Y dos, en el caso de México es un poco diferente. La apreciación del peso generada por estos flujos de capital han hecho que las empresas mexicanas prefieran endeudarse en el extranjero, toman crédito en dólares a tasas de interés más bajas con una moneda apreciada. Eso es un fenómeno que nos está causando. Y el segundo fenómeno es que con la apreciación que esto ha generado en el peso, las empresas grandes mexicanas han preferido invertir en el extranjero que dentro del propio país. Entonces se ha generado un flujo de inversión extranjera de mexicanos hacia el exterior, mientras que los bancos no han reactivado el...
¿Y hogares? ¿Y households?
Es bajo de las familias. ¿Cuánto es el nivel de endeudamiento respecto del ingreso?
De las familias es alto. Es alto. Si analizamos la encuesta de ingreso-gasto de los hogares, se ha elevado el endeudamiento de los hogares.
Pero no es tan alto porque el nivel de financiarización y de penetración del sector financiero en la mayoría de los hogares es muy bajo. Se calcula que es el 30% de las familias el que está bancarizado.
¿Alguien más en esta ronda o empezamos la...
Just a request, if you can tell us the results of the first tables on graph results.
Okay, sure. Okay, the first thing about consumption is that most of the credit growth in Turkey, and it seems like in some other places, including Brazil and South Africa and places like that, go to consumption in terms of go to households for household borrowing, or as credit for construction, which is not necessarily a productive sector either. And this is happening in a period when the interest rates worldwide, in Europe and in the US, are very close to 0%, which allowed the central banks of some developing countries to pull their interest rates down as well. So in the case of Turkey, for example, the interest rate up until very recently was around 5%, the discount rate, the central bank's interest rate. And given that the inflation was about 8%, we basically had a negative interest rate, the negative real interest rate, okay? So even though there was demand for credit, that did not increase the interest rates. And in a situation like this, the position that the government usually takes is to let it happen because it's making people happy, no? You borrow, consume more, buy cars, buy houses, whatever, and the economy grows. And they knew, for example, that the credit was growing too fast. They took some measures, the central bank took some measures to slow down that growth. But they didn't want to kill it, they didn't want to stop it all the way. Because if your economy is dependent on the growth of the credit, then you don't really want it. Especially if you have elections coming up or whatever, things like that. And that goes back to sort of the question about the Turkish lira. In the same period, you have an appreciation of the Turkish lira, together with an increase in imports. Okay, that also adds to the happy cycle, sort of, so to speak. You can buy more imported products, more electronics and stuff and all those kind of things. And what happened basically was, after the Fed announced that they would slow down the credit expansion, the Turkish lira started sliding down, like many other currencies. So from the day that Fed announced it, sort of like towards the end of May 2013, to the early January, the Turkish lira lost more than 30% of its value. And at the end, the central bank had to increase the interest rates, a very sharp increase. So from average of 5%, they pulled it back to 10%, a very rapid increase of the interest rates. So in terms of lira versus euro, or whether the Turkish economy, now it seems like, especially after the crisis of euro, on both sides, the talks about Turkey joining the Union has kind of like went away. And it's funny, it's like the Turks began saying, well, there's a crisis there, we don't want that. There's talk about whether Greece should leave the Union or not. So, you know, it seems like everybody's taking it easy. They're not really pushing that way. And the public opinion, interestingly, turned against joining the EU as well with this. But, having said that, if capital flows, they stopped coming into Turkey towards the end of last year. If we do not get capital flows this year, that means we're going to have a very significant financial crisis, a very sharp decline in the economic growth, and most likely a significant increase in the rate of inflation as well. But that all goes to show my point that you take the capital flows from the picture, everything is masked in the economy. Okay? Unless you keep having that, you have the situation. And the idea was, of course, that the Turkish economy was growing, so everybody was like, you know, The Economist, I guess, the journal The Economist, had at some point talked about the Turkish miracle. Because it's growing fast. And they were doing the calculation in dollars, the GDP. If you have, your currency appreciates, in dollars, it looks like your GDP has increased a lot. So they had a graph showing that the Turkish GDP has increased by 200% since the beginning of 2000. And we were all, you know, this is a totally, completely wrong calculation. But just sort of like say what's obvious is the whole setup is dependent on the inflow of capital. And in that sense, there are similarities with Mexico, but there are sort of like differences as well, especially the ones you were talking about. In the case of Turkey and in some other developing countries, this is happening through the credit markets. And this is happening through mostly household borrowing. And it seems like in Mexico, this is a very low rate of borrowing going on, which at least in terms of the credit market, you do not have the same fragilities, but you might have them through different channels, I guess.
¿Otras preguntas, compañeros?
All the data is from the IMF, very trustable. But the IMF has statistics called International Financial Statistics, IFS, and Balance of Payment Statistics, BOP, so all the numbers. So, and I suppose these are right. Sometimes IMF messes up, but it takes it from economy, so you have to look at it. But I think this seems right for at least for the case of Mexico.
Nacho.
Most of the countries you saw into analysis.
¿Puedes pasar el micrófono, por favor?
Yeah, I was saying that most of the countries you show into analysis follow an inflation target and monetary policy framework. So I was wondering whether you empirical data shows some sort of relationship between this kind of monetary policy approach and capital inflows, and particularly the speed of capital inflows from time to time, on the one hand. And so, do you envisage any, does do emerging market economies, central banks react to capital inflows and credit dynamics same way as, say, developed economies, central banks. Central bank approaches monetary policy and deals with credit expansion and capital inflows.
¿Alguna otra pregunta?
How is the financialization and small economies?
¿Alguna otra pregunta? Bueno, yo tendría una pregunta que más bien tiene que ver con la dinámica. Me llama mucho la atención la gráfica, digamos, teórica que podría hacerse con el ciclo 2000-2014. Es una expansión, una caída, y después tenemos una nueva expansión y una estabilización a un nivel relativamente alto. Y está, creo que has hecho un comentario de que esto tiene que ver con la política de la FED, que parece muy claro que está ahí metida, ¿no? Pues la pregunta sería si no estamos en una situación en la cual la dinámica económica de los países en desarrollo y emergentes está totalmente determinada por factores externos, y en ese sentido lo que nos queda es esto que decía Margaret Thatcher, de que no hay alternativa, estamos en una tina. Entonces ese sería uno de los elementos. La otra es que tal vez no entendí bien la idea, pero en algún momento entendí que los flujos de capital son dependientes del crecimiento del país. Pero me parece que es de otra forma, o sea, esos flujos están pegando sobre el crecimiento más bien.
Capital dependent growth.
Eso, sí. ¿Sí? Ok, entonces estaba alrededor. Entonces, nada más serían esas.
Now, in terms of the relationship between inflation targeting and capital inflow, the main idea behind inflation targeting, I think, among many others, is to make sure that for the financial sector, the risks are minimized. Because those who lend money are affected by inflation in a negative way, right? If you lend money at a certain interest rate, then so inflation targeting essentially was in a way imposed on many of the developing countries. In the case of Turkey, it was basically imposed by the IMF after the 2000-2001 crisis. And what it meant was that you make sure that the inflation remains at a certain level so that financial investments or financial investors can make their decisions according to this, decrease the uncertainty for them. So most of the time, you see that if the economy has inflation targeting programs, then you will see more capital flowing to those economies because they're more sort of like secure about this. But on the other side, if a central bank is implementing inflation targeting, like the Turkish Central Bank was doing, they tie their hands in the sense that they cannot implement any other policy. They saw, the central bank in Turkey saw that there was a significant increase in capital flows. The currency was over-appreciating. The credit was expanding too fast. So they could not do anything because their policy priority was to target inflation. So they tried to use different measures to deal with it. For example, they tried playing with the reserve requirement ratios. They tried putting different reserve requirement ratios on different things. They tried to prevent people from borrowing by, for example, the recent thing that they did is to make it illegal to buy cell phones on credit. A lot of people buy expensive cell phones by borrowing. So, but there's always financial innovations in the sense that people get around them, you know. So those measures don't really function. So that's one of the things that the inflation targeting essentially does in this case, that you don't have a lot of options. And we know the famous trilemma that you have an open capital account and you can target the exchange rate and in interest rate. And now you can add something to that, I suppose, that you can't quite control the credit growth in the domestic economy either, if it's tied to the capital inflows. Okay, so in that sense, it makes the picture more complicated. And in countries, in most developing countries, I suppose it might be the case in Mexico as well, inflation partly depends on your exchange rate because a lot of products are imported. There's a pass-through effect. So at times of instability, like the ones we're having right now, inflation targeting becomes impossible as well when you have a 30% depreciation of your currency, and if you have a high import content in your consumption basket, then inflation targeting has to be recessionary. That is, the only way that you can control inflation is by increasing the interest rates. And if you increase the interest rates, you slow down credit growth, you slow down everything, and you basically lead to a recession. So inflation controlling, if it's successful, will lead to a recession. If not successful, if you don't do this, you will most likely have some sort of a stagflation. So you don't really have much of a choice in that sense. That's if you have this kind of a setup. But coming back to your original question about short-term and long-term capital flows, especially in this case, for example, if you look at this one, you have $70 billion in 1 year coming into your economy. If you add it at the last 10 years, it's about $450 billion. The GDP is around $800 billion. So half your GDP, more than half of your GDP coming in. Now, the result will depend on how you use these inflows. Okay? It's, in terms of policy, you can think about having capital controls that you don't let the capital come in, but also another option is to direct this capital to productive uses. Okay? And that hasn't been done either. That's sort of like, that's not even a policy choice. That's not even something that the policymakers think about or debate or whatever. Okay? And you have basically $450 billion coming into your economy, and at the end, when it stops coming, you still have a crisis, you still have a decline in your GDP. So in that sense, that's sort of like, that's why you have capital inflow dependent economic growth. Because the link is capital coming in, leading to credit, leading to consumption, and then growth. And then when you have the problem at the beginning, the rest sort of like collapses as well. Okay? And in terms of the financialization in the small economies, it seems to me this is one of the main mechanisms that's going on. In the sense that in a lot of developing countries, you have the financialization of the households who are borrowing more and more, and that is most of the time sort of financed by the inflows of capital. Okay? Then, comes back to your question of whether there is an alternative or not. And it seems like in this setup, the only alternative is either to use it for some productive, investment purposes, but then the question is, will the capital come in? If you have sort of rules about you can do this or that or whatever, and if not, maybe we don't have an alternative. Maybe we have to seriously think about what would be an alternative. Because if you have an open capital account, and if you have this kind of a setup where your domestic economy almost completely depends on these capital inflows, then you don't seem to have an alternative. So you have to think about it, and whether that alternative is just to stop capital flows or to think about something else. I think that's a very important question that the economies like Turkey and other South Africa, Brazil, or whatever, Brazil has some sort of capital controls, but they will have to seriously consider, they will have to seriously think if they want to have some sort of independent, at least autonomous macroeconomic policy environment. I'm not that.
¿Alguna otra pregunta?
What's happening with the capital inflows in the emerging economies? With the non-conventional measures the Fed's has taken, and really with the capital inflows increase the credit emission in this graphic. Podemos observar que la relación no se cumple siempre. Entonces, esa era mi pregunta. O sea, en realidad, la entrada de capitales sí permite que la emisión de crédito se genere, o en realidad son las no condiciones de pago las que en realidad hacen posible que el crédito no se emita. ¿Sí O sea, digamos, la entrada de capitales llega a apreciar la moneda del país, y esto hace pertinente que la tasa de interés siga estando muy alta para que los agentes puedan llegar a adquirir el crédito, ¿no? Pero en realidad es esta medida, o sea, la relación causal es que la medida de la entrada de capitales es la que efectúa que no se emita el crédito, o en realidad son las condiciones de no poder pagarlo en un futuro las que hacen posible que no se aumente la emisión de crédito.
Another question?
Estos flujos de capital en una economía mundial tan inestable no pueden ser entonces ser considerados como flujos que garanticen el crecimiento de mediano a largo plazo.
¿Sí? ¿Ninguna otra pregunta?
Okay. I mean, in terms of your question, if I'm understanding it right, the relationship is as follows. The capital inflows could come in different forms. Okay? One form is when the banks, domestic banks, borrow from outside, bring it into the economy. That's going to be a capital inflow, and then land in the economy. In that case, you have a very direct link. The capital flow is immediately converted into credit, and depending on your sort of, if you believe in endogenous credit creation, endogenous money theories, depending on your money multiplier, so to speak, that will create a certain amount of credit. The second way is the credit could come to the stock market.
The credit could come, the foreign capital inflow could come to housing market. In these markets, it increases the values of the assets. When the values of the assets go up, that means those who hold these assets can borrow more, okay, using them as collateral, and the banks will, give them more loans. Now, this is what creates also the capital inflows at the same time, creates the appreciation of the currency. Now, this creates some sort of a dynamic that could go on for a while, because the appreciation of the currency makes imports cheaper, so you start importing more, okay, which could mean borrowing more, because if you're consuming expensive imports, you could borrow more, and as there is demand for credit, then the banks will provide more credit, maybe will borrow more from outside, from abroad, and then you have this sort of like cycle going on. If you put it on a picture, it could be the same money basically going around in terms of the flow, but the stock keeps increasing. So that is sort of like the basic relationship. Okay? And one way is to tell this story, and you can convince someone by telling a story. Another way is to use the graphs to see if they move together. And then a third way is the last thing I showed, to look at it on a monthly basis and to see if there's any statistical correlation between these two variables after you control for other stuff. So that might maybe be convincing you. Okay. And for your question, can you sort of open it up a bit?
Sí, bueno, yo lo que entiendo es que los flujos de capital, estoy entendiendo que no son flujos hacia de inversión directa, sino son flujos financieros y son flujos de corto plazo, por lo cual efectivamente pueden servir para aumentar el crédito, pero precisamente porque son flujos de corto plazo en una economía inestable, ¿sí?, estos no pueden ser considerados o tomados en cuenta para el crecimiento, o pueden ser tomados en cuenta con reserva para el crecimiento de los países emergentes, porque en un momento dado, esos, en lugar de ser flujos hacia adentro de la economía, puede ser flujos hacia afuera de la economía.
Sí, sí.
¿No? Entonces eso limita pues la capacidad de funcionamiento de estos flujos para generar crecimiento económico.
Exactly. I mean, as I said, one thing you can do is, I don't want short-term ones. That's one thing you can do. But in the short run, most of the time, the government is happy with, because in the short run, it creates growth. You have an increase in consumption and it creates growth. A lot of countries accumulate reserves to deal with this, which is costly itself, because accumulating reserves is basically you borrow from outside, you're paying an interest, but then you hold that money doesn't earn any interest. So for the whole country, that's actually a loss, that's actually a cost for the whole economy. And in some cases, in the Turkish case, the central bank did two things. They held reserves, they also forced banks to hold reserves as well. So if the banks were borrowing from abroad, say if you're a bank, you go outside, you borrow $100 million, you bring it here, they wouldn't let you use $100 million. They would say, put 10 million here, and then use the rest. Now that doesn't solve the problem. That's sort of that's a policy to slow it down. That's some sort of a control to slow it down. What would solve the problem is like if the central bank got the 100 million and said, don't do anything, but then the bank wouldn't do this, right? So what else can you do in terms of policy if you have these short-term things? You can't do much. You cannot do much. That's just sort of like you can try to sort of minimize them at most, to minimize their effect at most. And other than that, you maybe hope that they don't leave, the capital does not leave while you're in office. Capital leaves after you leave office, basically. That's, as a policymaker, that seems like that's the only thing you can do, unless you say no to all of it.
And my first question was, what's happened with the capital inflows in the emerging economies with the non-conventional measures that the Fed has taken?
Right, right. And that's part of the story. The main sort of increase here is after 2009 is mainly due to Fed's and European Central Bank's policies, where you have 0% interest rates, 0.25% interest rates. That increase here, happening after the crisis, this increase here and the leveling here is basically coming from the Federal Reserve or the European Central Bank. Okay, and that's what is called carry trade. You're borrowing here and then lending here. So that's the basic effect of the Fed's policies.
Cosas que me gustaría que elaboraras más la idea de los, creo que mencionaste 5 países frágiles, con mayor fragilidad. Entonces, digamos, que elaboraras un poco más cuál es la fragilidad que tienen los 5 países y qué podemos esperar para los próximos años que va a ocurrir con esas experiencias, esos países.
The fragile 5, as the Financial Times called, are the 5 economies, including Turkey, who have large current account deficits, large amounts of short-term foreign debt, okay, and some of them have very large amounts of credit expansion, domestic credit expansion, okay. And the reason that these economies are very fragile, take Turkish economy. The Turkish economy last year had a current account deficit which was about 7.5% of the GDP. The thing about that, that's a very large amount, okay? When you have a current account deficit, when essentially you are importing more than you're exporting, the main problem always is you have to have a certain amount of capital inflow to finance it, unless you are the United States, where you print your own money and then finance it like that. Now, this is the first thing. If you have above 5% current account deficit, this is usually considered a serious situation. Okay, so if you have an economy that's about 800 billion, the GDP is about 800 billion, 10% of it is the current account deficit is around $70 billion in Turkey. Now keep this number in mind, $70 billion current account deficit. Plus, the Turkish banks and non-financial corporations borrowed $130 billion from abroad in short-term debt that they have to pay this year. So you have $70 billion just to cover the current account deficit and $130 billion to pay the debt. That's about $200 billion, which means this year, not to have a problem, I'm not talking about any growth or anything, just not to have any problem, you need about $200 billion to come into the economy, which it won't, obviously. At the highest level, it was $70 billion. Or you need to be able to roll over the short-term debt. If the banks can roll over their debt from foreign countries, then that's, that postpones the problem. The problem is there too. So this is a similar situation in the other economies in the fragile 5, for the South African banks or for the Indonesian economy and stuff like that. You have, for Brazil, you have a similar situation. There's a high amount of foreign borrowing that has been done, okay? And this becomes a very significant issue, especially after the depreciation of the currency. Because if you have about 30% of depreciation of the currency, that means that your debt actually has increased by 30% because your earnings are in domestic currency and you have borrowed in foreign currency. Okay? Now, what's going to happen to the fragile five or the developing economies? Now, the way it seems that all we can do in developing economies is to pray that the US economy keeps going down. Pray that the US economy does not grow. Because the setup is very interesting. If the US economy grows, the Fed will keep cutting the credit expansion. The capital flows will turn back to the US. In the short run, it seems like the only thing that can save the developing countries, and especially the fragile ones, is a bigger crisis in the US, so to speak. That will, because if you read the Fed's announcements, basically, the Federal Reserve recently said that we're doing this, we're slowing down the credit expansion, and what's happening in the developing economies is not our problem. That's their problem, and we're not concerned about this. We're only concerned about what happens with the inflation in the US, essentially. If the inflation in the US starts picking up, we'll increase the interest rates. So
inflation is very low in the United States.
No, but exactly. But the Fed,
inflation is a problem in the United States.
It's not. But the Fed's rhetoric is that that if the inflation starts sort of like picking up, they're not going to do it anytime soon. They're not going to increase the interest rates anytime soon. But even like slowing down their credit expansion is having very significant impact on the developing economies. Imagine if the inflation was going up in the US. Imagine that the Fed actually increased the interest rates. Then you would probably not have a slowdown in capital flows, but you'd have the capital outflows. That's my take. In this year, it seems like, if the capital does not keep flowing, you have a problem. Because these problems have accumulated over the last 4 or 5 years, and they won't be solved easily, this year. And this sudden stop or the reversal of the capital will make things really hard for the. So what I expect in the next year or so, in the case of Turkey, what I expect is a year of very, very low growth rate and probably a high inflation. But in general, for the fragile economies, a significant slowdown in their economic growth, if not a turn into negative, with the caveat that the capital flows don't resume going back there. Okay? That's sort of this understanding I have here is basically that if the capital flows don't resume, you will have a crisis, a very widespread crisis in the developing economies, starting from the fragile five.
¿Puede haber un crecimiento en Estados Unidos que cree pocos empleos? Porque de hecho el indicador para PIB es la tasa de desempleo. Entonces no se necesita caer la economía, simplemente que crezca creando pocos empleos.
I mean, but the problem is, in the US, if you look at it, the long-term interest rates have started going up, which is part of the reason why some of the capital started going back to Turkey. So the US economy is not growing much, but the interest rates sort of like began increasing. But the ideal for the developing economies of the US economy not growing at all. That's the point. In this setup, in this world setup. Now there's one thing that I haven't discussed at all, that's completely out of this picture, is the place of China in this setup. Because this setup has the US and Europe, and then the developing and emerging markets around it, and the capital flows. But the Chinese growth has been one of the sort of things that contributed to the developing economy's growth in terms of its demand for resources, its demand for some different types of inputs. And it seems like recently the Chinese economy has also been slowing down. So to these financial fragilities, one probably needs to add the potential real fragilities that's going to be coming through the export channel, through the channel that exports to China are likely to go down. Now, if you add that on top of it, so let me just frame it out this way then. The US should not grow, but China should grow at the same time to save the... What you have essentially is this integrated system, and what you basically have very little macroeconomic space and very much, capital dependent or export dependent models of growth in the world. So going back to your original question, that seems like, in most cases, the dynamics will depend on what happens in the US and Europe, as well as in China. From the financial side, what happens to the Fed's decisions, and from the export channel side, what happens to the Chinese growth. And then, of course, you have to tie the China and US together as well. China, for the first time, had a current account deficit recently. So it's a very complicated picture in that sense that unless you have some sort of a coordinated policy action that's at the same time trying to take care of the needs of the developing economies and the US economy done by the Fed, then it seems like the future is not so bright.
Una pregunta, por favor, aunque está un poquito fuera de... Pero Turquía no es un productor de energía.
No.
Importa prácticamente todo. Y los precios no parecen bajar en esa zona, tanto el petróleo como el gas. ¿Cómo está?
No, that's one of the main problems. That is, when you have a current account deficit, a very significant portion of the current account deficit in Turkey is energy imports. And there isn't much you can do about that, because we have winters. It gets cold, so you have to buy the natural gas, for example. And, you may not be, you can stop driving, you can stop this, but certain items you have to have them. And that's about more than half of the current account deficit is going down, which makes it extremely sort of difficult in the sense that when you have a financial crisis, okay, for 1 year or 2 years, you don't buy anything, you don't import anything, you have a current account surplus, so that, but in the case of Turkey, that's not a possibility. We have to have some inflow of, which makes it peculiar in that sense, that, it makes a specific case in that sense. You're right.
¿Alguna otra pregunta, compañeros?
Me atrevo. En materia de déficit fiscal, creo que hay otro canal, el canal relativo a la política fiscal, porque estos grandes influjos de capital han permitido, o en el caso de México, han llegado a comprar deuda pública con tasas más bajas de interés, ¿no? Y de alguna manera son de corto plazo, ¿no? Han permitido que la tasa líder CETES se coloque muy abajo y tendría otro tipo de reacción la salida de ¿no? Y no has hablado del aspecto fiscal. ¿Qué opinas?
No. The main reason that I did not talk about the public debt is because, well, the first reason is I wanted to highlight the private side of the story. Because in the previous episodes, when you have all this, for example, take Argentina in this case, in these cases, in the initial crisis, you have mostly government debt. Okay, the government borrows from outside, then can't pay, and you have the crisis. Now, it seems to me now we're faced with something totally different. In a lot of countries, especially since early 2000s, they have what we call primary surpluses. There's still government borrowing going on, but the governments, either by pressure from the IMF or for various reasons, they began controlling the fiscal deficits. The fiscal deficits are not as large. The foreign borrowing of the government in general is not as large compared with the private borrowing. But we all know that at times of crises, private debt is easily converted to public debt, especially if it's private foreign debt, when banks or companies cannot pay to the foreign banks. Most of the time, the government will pay for that. And it's going to be public debt. And it's going to be paid by the whole population. The way that the system is set up. In most cases, we're probably going to talk about public debt again once this private debt, if this private debt collapses. And if the public sort of assumes the private debts and starts paying them. There could be cases, of course, where the public debt is still large and important. But for a lot of the economies, together with the inflation targeting, one of the things, you have two policies, inflation targeting plus primary surpluses for countries who especially had instability in the late 1990s and 2000s, where they have cut their public spendings and they have taken them under control. So this time it's going to be a different crisis.
Seems one more thing, but I mean you're right. But foreign public debt might not be a problem. But what about domestic public debt? That can be also a problem in some countries.
Yes.
For instance, here in this country, and I'm afraid this is more or less the situation in some other countries. I mean, public domestic debt can also be a problem. I mean, it's not so much that the public debt is related to the foreign exchange, but even if it is not, indexed to the foreign exchange, I mean, in the case of Mexico, and this also applies to other countries, you have, I mean, the ability of the government to comply with domestic public debt also depends on foreign exchange gathered from exports and from domestic economic activity. So the economy is slowed down, then that will use the ability of the government to deal with public domestic debt. So that is also a problem.
You're absolutely right. You're absolutely right.
The other thing that is to be added is that part of that domestic debt is external debt.
Yeah.
In the sense
I mean, it's denominated in domestic currency, but it's somehow related to the exchange rate.
No, exactly. I mean, you have to add that to the story as well. You're absolutely right. I mean, I'm not saying that this is the complete story or whatever. You have to add that to the story. You're absolutely right.
¿Alguna otra pregunta? Bueno, pues yo creo que... ¿Perdón? ¿Sí?
¿Cuáles serían unas medidas específicas para dirigir todos esos capital inflows to the investment? Nos hablaste de controles, pero ¿qué tipo de controles o políticos que se controlan?
I mean, if you don't have capital controls, that's sort of like, that goes to that question as well. If you do not have capital control, and if you have short-term capital inflows, there aren't a whole set of policies you can use. But what you can do, basically, is you can control or give incentives to the banks to use this lending to more productive resources. So it's not necessarily related to capital flows, but you could have rules about how banks allocate their credit. You could say that you can lend only this much of your portfolio to consumption, and then this much you have to lend to agriculture, to investment, to whatever. That's with the short term. That won't necessarily solve the problem. It might sort of like, make it a little bit less
fragile, but it might not. But the other thing, you can promote, instead of short-term inflows, you can promote long-term capital inflows. And you have to, but that becomes tricky as well, because most of the foreign capital inflows, even the long-term ones, we know that are not coming to create new investment, but they're rather coming to buy already established of the economy either. So, but you might actually be able to come up with rules about that and promote certain types of longer-term investments. That's pretty much you have.
Or else they require huge tax breaks, which also...
Or, exactly. That takes away the benefits.
Okay. Bueno, pues yo creo que estas dos pláticas lo que dan es material para reflexionar sobre todo sobre alternativas de qué hacer. La política económica como está y la dinámica de las economías en desarrollo y emergentes no es tan... No puede haber mucho optimismo acerca del futuro de cómo se van a mover. En particular, pues, la economía mexicana está con un crecimiento muy bajo desde hace muchos años y no parece que se vaya a superar. Entonces yo creo que estas pláticas y estos elementos que nos muestran las peculiaridades de la economía mexicana, pero también las cosas que tienen en común con otras economías son útiles para entender y reflexionar, y sobre todo pues, para tratar de generar algunas alternativas de cómo entrar al asunto. En alguno de los textos que mandó el profesor Orhangazi viene al final un material que dice que hay que cambiar el régimen drásticamente del capitalismo a otra cosa. Entonces, pues queda como parte de la reflexión. Pues a nombre de la doctora Noemí Levy, que no pudo estar hoy aquí, pues le agradecemos al doctor Özgür Orhangazi sus conferencias y bueno, pues muchas gracias.
Muchas gracias.